Yeah.
Alright, so the live stream's running. I'm gonna get the rest of the brothers to come in.
You're gonna be going first.
I don't know, I accidentally pressed the button. I don't know if it turned off. Is that on?
Yeah, it's on.
You want to sit down or are you going
I don't know, I'll stand, it's fine. Wa alaikum salam wa barakatuh.
Good. Inshallah, it'll be beneficial.
Excellent.
Yeah, cup of joy, you know what I'm saying? Assalamu alaikum.
Wa alaikum salam wa barakatuh.
Salam
Assalamu alaikum. How are you all? Assalamu alaikum.
Oh my goodness, I can't wait to witness your speech. I'm so
My
excited.
speech?
Yes,
Yeah, brother, it's a presentation. I'm not giving a speech.
And I just dropped it right in the brother's chat. It should be on. It's on right now.
What are you going to do?
Oh, no. No, that's all my.
Assalamu alaikum. How are you, bro? How's everything? Alhamdulillah, can't complain.
All my travels done.
Yeah, go ahead.
So far, here.
Are we waiting on anyone else?
Yeah.
Huh?
One more.
Okay.
Inshallah, Ahmad is teaching this class?
No, Ahmed's teaching it. Not to say
Should I just press the next button to go to the next slide?
Try it.
No. Maybe you have to go to the page.
Screen extended.
Click. Will I click it?
Yeah, there we go. Now it's good.
Okay. Cool.
excuse me, Ustad, I need to go to thank this group.
Do you want me to test it? The link, it's working. I guess we'll get started then, inshallah. So previously in our last presentation, I don't know if I'm seeing some new faces, so maybe some of you guys weren't here for it, but we discussed, savings, budgeting, how you can save your money, account for your money, budget, all of that stuff. So we're assuming at this point you have some shekels saved up, and we're going to be looking at what are the next steps, because now that you have some money saved, more money, more problems, right? So now you have to invest it, and now you got to do stuff with it. So we're going to be going over investing your money. So what is investing? Basically, you're buying an asset class, whether that's a bond, whether you're buying into a business, whether, it can kind of really be anything. And you want something obviously that's going to be increasing in value over time so that you can get your money's worth. And the thing is, there's also the opportunity cost of money. So just having the money by itself is going to be costing you money. So you want an asset that is going to not only perform, but at least keep up with, inflation and the opportunity cost of your money. So what we're going to be looking at is a long-term strategy. That's what is most effective. Quick money, that doesn't tend to usually work very well. Where the money's made is in the long term. So why should you invest? The first thing is that it protects your savings. So now let's say that you have a little bit of money saved up. It just sitting in an account, it's going to be losing value over time just because there's things like inflation, and you could be doing other stuff with your money. That money's locked up, so you're not able to use it. So there's the opportunity cost of not being able to use that money. So even if you're adding to it over time, it's still going to be losing its value. Let's say the house that you could buy today, if your money is just not increasing, in 10 years, you're not going to be able to buy that same house. So your money basically loses its value by just sitting in an account. And since we're Muslim, we're not able to put it in a savings account that gives you interest over time. So that only leaves us with the option of investing our money. The other thing is long-term wealth. So just simply saving over time is not really going to do it because there's only so much that you can save. A lot of us have jobs where we're exchanging our time for money, and we only have so much time that we can be working. So that kind of limits us. But when you're investing your money, you don't need your time. The money's being invested for you. So it kind of gives you an increased capacity to grow your wealth. And the other thing is free money, which, nothing is free, but we're going to be going over how there are some ways that, you can increase that without having to really work. So this is a graph that kind of shows why just simply saving your money just is not enough, because with inflation, you're constantly losing value in your money, even though your actual money might be increasing as a number, but it's decreasing in value. So this graph is showing the S&P 500 adjusted for inflation. And the S&P 500 is basically a basket of the 500 biggest companies in America. So when they say invest in America or you're investing in the economy, a lot of times it's referring to the S&P 500, the biggest 500 companies, probably in the world too. So the bottom line, the red one is showing the purchasing power of the dollar. So as you can see, from 1995 up until now, it's lost about 55% of its value, whereas the S&P 500 has gained about 1,000% of its value. And the other thing is investing allows your money to grow at an exponential rate. So as you're adding to your savings, it's growing and you're getting returns on your returns, basically. That's what allows it to grow at an exponential rate. So what that means is if you invested in something and you doubled your money, and let's say it's doubling every year, it grows exponentially because let's say you started with $50, it grows to 100, and then you're getting double the 100 instead of just your $50. And that's kind of what the graph shows right here. As you can see, it's like curved up instead of it just going straight. And this is only investing $15 in a day. After 50 years, you'll have about 2.5 million. Does anyone want to calculate what that would be if it wasn't invested, if you just saved $15 a day and didn't invest it?
Probably like maybe 4,500.
4,500 over 50 years? I think, what did you do the math last time? What, do you remember what it was? Huh?
Around 270.
Around 270?
270?
Yeah, so I mean, you'd be somewhere around like down here if you didn't invest it and you were just like, you know, just saving your money. It would be somewhere down there. So that just kind of goes to show you like what you're missing out on. And the other thing is time is very important. You want to start as soon as possible because that's the biggest factor. Because see, in the beginning, you're not like, there's not that much difference in the beginning. If you were to just be saving, it would be a linear line that would kind of go like that. So the biggest difference is made towards the end. So the earlier you start, it's going to make a really big difference, you know, in 10, 15, 20, 50 years. So the last point that I made about free money, it's not necessarily free money, but it's money that you would be saving, which kind of translates into free money. It's money that you otherwise would not have to spend. The first thing is 401k match. A lot of companies will match whatever you contribute to a 401k. Let's say like one example is 100% match up to 5%. So what that means is for the first 5% of your wages that you contribute to a 401k account, they'll match that 100%. That's just an example. You can also contribute more, but let's say maybe they won't match it. Sometimes they'll do like 50% from 5 to 10% that you contribute. But the first 100% that they're contributing, that's basically free money. They're giving you dollar for dollar, whatever that you're putting in. And that can really add up because even if your investments doesn't grow, you're still doubling your money right off the bat. The other thing is there's tax savings. There's something called the Savers Credit, and it's a tax credit of 10, 20, or 50% of whatever you contribute to a retirement account. So at the end of the year, whenever you're filing your taxes, if you owe money, it's going to reduce what you owe. Or if you're going to be getting a refund, you might be getting a larger refund. And the fact that it's a credit and not a deduction, that means it's going to reduce what you owe dollar for dollar instead of reducing your income, which would have a lesser effect, if that makes sense. There's also passive growth. So in the beginning, we mentioned that from working, you're exchanging your time for money. But when you invest, it's not your time that you're giving up. Your money starts to work for you. Let's say if you put it into a company like Costco, people are shopping there all the time. Your money's working for you while you can still be making money at your job.
Like a question.
I'll take some questions, I guess.
Would you recommend like investing into like smaller local businesses?
No.
As well? No.
I mean, unless it's, something that you know of and is going to be very like lucrative. A lot of times that it's also very like complex to invest in it because there's a lot of ins and outs. So it's like, are you just gonna like give someone your money, be like, hey, start your business with this, and then you kind of don't know later on? Like you would want to have like a contract, and you would want to know how much ownership you're getting and all that stuff. So it gets really complex. What I would recommend is buying into ETFs or index funds. You can buy fractional shares. Like let's say the S&P 500 is at $500. You can buy $100 worth. You can sell it and buy it at any time, so it's very easy. You can do it on your phone. But like with a local business, it's a lot more. You don't really know. Like you can't give someone your money today and then tomorrow be like, hey, I need that money back, because they probably, they bought inventory or something with it. So it's a bit more riskier. Any other questions before we move on to the next part?
So Brother Ahmed did a good job of kind of introducing why you should invest. Now our main goal is to kind of show you the different investment products, so you can distinguish their differences. Some of these, if you know more about them, you can tell if one is halal, what is haram. When you're at work and your money is invested, if it has a lot of bonds, now you will know, say, hey, no, I don't want this. So that's the goal to go into each of these. So before you invest, one, you need to have a goal, right? If your goal is to buy a home, that's a different strategy than if you're just trying to buy a car. Some of the investment products, there's a term called liquidity, right? How can you access them? Some of them you can access easily. If you have cash sitting somewhere, you can get that out easily. If you have a bond, if you invest in a bond, usually they're timed. It'll be like 5-year bond, 2-year bond, but obviously we're not investing in bond because they're non-halal. So all of those have different access, how you can access them. So we're going to talk about the risk ladder. The lowest risk obviously is cash. If you have money in your cash, you can access it today, right? The only thing is with inflation. Next is bonds. So bonds, we'll talk more about them, I think, in the next slide. Yeah, we'll talk about them in the next slide. But they're less riskier because your money is almost guaranteed. You invest $5,000 in a bond, they're going to say, Ash, will give you a $5,000 in 2 years. In the meantime, we'll give you interest. So it's almost guaranteed. Mutual funds, under the risk ladder, it's lower than stocks because individual stocks, say if you invest in Tesla or Kroger or whatever company, depending on how much profitable they are, what type of year they have, your value can fluctuate. As opposed to mutual fund, which is they group different stocks together. So it's like not putting all your eggs in one basket. If one of them doesn't perform well, the other stocks will perform. So you're kind of like balancing. ETF is similar like a mutual fund. We'll talk about them, the differences. And you have individual stocks, like I said. Oh, also, this. The higher the risk, the more the return. So if something is less risky, like a bond, right, they're going to say, we'll give you 5% interest twice a year, right? If you invest $1,000 every 6 months, they give you like $25. In 2 years, you have like $100 or something like that. But if you invest in something more riskier than a stock or than a bond, which is a stock, you might get more money in those 2 years, something like 10-20% returns. So you understand the difference between the risk and the return? Okay. So this is the different investment accounts we'll talk about. We'll talk about what is a stock, what is a bond, mutual fund, and then Brother Ahmed touched on 401ks, but we may talk more about it later, Roth IRA, and there's other accounts, HSA, which is like a health savings account, FSA, and Roth for kids, all those. So what is a stock? Stock is basically an ownership in a company, right? You have Al-Sham Market. If they want to expand their business, maybe they don't have a lot of money laying around to buy a new store or something like that, so they may decide to offer a share of their business to investors to raise money. Stocks are also known as equity, right? And you own a fraction of the company. If you own a share of a stock, depending on how large your share is, you can have voting rights. So if you have a lot of shares of Apple, if they say, hey, we're trying to hire a new guy, big decisions, they're going to put it to a vote or something like that, So a unit of a stock is called a share, like I said. And then there's stocks that primarily give out what is called dividend, like a profit. So they'll say, hey, every year when we have a profit, we'll share, and then based on how much your ownership is, you'll get a fraction of that share. Some stocks don't offer dividend. Your gains from them is purely on the value of the share you have. Stocks can be bought and sold on public exchanges. So you heard New York Stock Exchange, NASDAQ, those kind of stock exchanges. And like I said, corporations are mainly the ones issuing stock, like public companies, and they do that to, either raise money to do their operations day to day, or expand their businesses. So that's the stock. So bonds, we'll touch on them. So bonds is just a loan. So you are the person who are giving a loan to the issuer of the bond. So whoever is issuing the bond, now they're the borrower, right? They're borrowing money from you. And governments will do it. Also, companies will also offer these bonds in exchange for they'll give you interests, which is haram in Islam. And that interest rate is like fixed. So, like I said, the example I was giving, they will say we'll give you 5% interest 2 years. So you'll hear a maturity date. It'll say your bond will mature in 2 years. So they'll give you back your principal money that you invested and all the interest they were giving you. They will do it to even local municipalities might issue bonds to say they want to build a road or something, just to finance their projects. Lower risks than stock, and we mentioned they're haram. So now we get into mutual funds. Mutual fund is a way to diversify your stocks and to reduce your risk, as opposed to investing in individual stocks. You can invest in a mutual fund. So mutual fund they pool money from different investors. Okay, like I said, they offer diversification. It's like simple, right? Usually the mutual fund are actively managed, so you don't do anything. You just buy the fund. They go research the companies for you. You don't have to spend time researching individual companies, reading their sheets. There'll be like a fund manager who's doing all that stuff, and they have a group of researchers. So in a mutual fund, this is one of the difference between a mutual fund and an ETF. Investors own shares of the fund. So the mutual fund is going to go buy different stocks. Say there's a company that I use, they offer a mutual fund called Amana Income, for example. If you go to Amana Income, you open it, the holdings, all the companies they hold shares from, you'll see Apple or Nvidia, different companies. When you own a share of Amana Income, you own that fund. You don't particularly own Apple, a share of Apple, like I was saying in the stocks, right? If you buy a stock of Apple, you kind of own a small fraction of Apple. But if you buy into the mutual fund, you own a share of the fund, not the stocks inside the fund. So that's one key difference. And like I said, it's actively managed, and investment portfolio managers will decide when to buy different companies, right? And sell them. Those are the examples. So this one is Amana Growth. So this one they focus on big companies. And then they have Amana Income, which is like focusing on companies that offer dividend. So they'll give you a share of their profit. So any question on mutual funds? Okay. Oh, Hamza has a question. Yes.
Some mutual funds, they may potentially be involved in bonds, in which case we would avoid those.
Yes.
Bonds are just interest bearing.
Exactly.
Okay.
Yes. But
Some
companies,
mutual funds are like
yeah,
stock specific.
yeah, stock specific. They can be for different values. Whatever they're doing. Maybe some of them are just doing tech stocks, or some of them are just doing bonds. But these ones that we shared, they're like a Sharia compliant. They will say we're Sharia compliant, so they're gonna screen the companies and make sure there's no bonds or anything like that. Yeah, so they'll do all the research for you. You don't have to worry about that. Okay. So now ETF. Some people might say, what is the difference between the ETF and the mutual fund? So the ETF are called exchange traded funds. They are professionally managed funds, similar to a mutual fund, but they trade like stocks. We'll get into the detail maybe in the other slide. Let me see if I have that in that slide. Yeah. I have another slide that will kind of side by side break it down. But we'll go through this one. So ETF, they have lower fees and more liquidity compared to mutual funds. We'll talk about why. ETFs can provide exposure to different asset classes. So there can be ETF just for bonds, ETF just for stocks, ETF just for timber. You know, if you care about commodities, tracking timber. So like I said, they can be actively managed. Some of them can be index-based. So like you have the S&P 500 that tracks, you know, large 500 companies. Some ETFs are just tracking those companies. So they'll be cheaper, right? Because they're not doing a lot of work. They're just trying to imitate and track those companies. So that's why it says they can be less fees. Oh, here's an example of ETF. So Wahid, a company based in New York, offers this HLAL, Halal Wahid ETF. It tracks the S&P 500. So what they do is, oh yeah, go ahead.
No, go ahead.
Oh, I was going to say, they look at the S&P 500, right? S&P 500, 500 companies, a lot of different companies. Some of them are not halal to invest in based on the type of company they are. Maybe they sell weapons or alcohol or something like that. So what this does is it looks at all those companies, removes them, and looks at the ones that are Sharia-based ones, and that's the fund you're buying into. And then there's another one, SPUS, also kind of similar thing, is tracking a different index.
Just for the sake of like clarity, can you define what liquidity means?
Yeah. So I was going to talk about this in the next one. So when you're buying a mutual fund, it'll be less liquid than ETF. What it means is you buy it, and then the fund managers of those funds, they're almost like looking at all the prices of different stocks, and they're buying when the market closes, right? Then they calculate how much money, you know, the value are, and then that's how they set their prices. But ETF, you can just trade it right now. You go to your, say you have Fidelity, right? You can now just sell your ETF, cash it out, right? But with the mutual fund, it'll take more time because the fund managers have to, you know, wait for the market to close and all that kind of stuff. So they're less liquid.
To put it simply, it's how fast you can get your money in and out.
There you go.
Yeah. Okay, so we talked about ETFs. So now we'll kind of compare them, you know, just to remind you again. So in a mutual fund, you can own a variety of securities or stocks in the mutual fund, right? Same as ETF. The ETF has different stocks inside of it. Mutual funds, shares can be purchased and sold only with the fund provider. This is another one key one. When you buy the Amana X or Amana Income, all those kind of mutual fund, you don't go to Fidelity to trade them. You have to go to that company's website, and then you trade with them. You're dealing with them. But with the ETF, you can trade between investors, right, on the stock exchange. And then for the mutual fund, that's what Hamza was mentioning, the liquidity, right? Orders settle only when the market closes. So you can buy it today. It has to wait for the market to close, and then your order will settle. But with the ETF, orders settle during market hours. So during the market hours, you can buy and sell the ETFs and not stocks inside the ETFs. And then with the mutual fund, they will typically say this is the minimum amount you have to buy something, right? And then with the ETF, minimum investment is typically equal to the share, equal to the price of one share. Mutual fund can be actively or passively managed. ETF can be actively managed, but a lot of them are passively managed because of the stuff they're tracking, right? A lot of them. Mutual fund will be less tax efficient. When you sell it, your profits will be capital gains. With the ETF, the way they structured it is more tax efficient. So that's the difference between those. And in the ETF, you can own the stocks in there, but the mutual fund, you're buying into the fund. That's the other thing. Yeah, go ahead.
So with ETFs, would you get higher tax returns, like because with as opposed to mutual funds?
Oh, I guess you'll pay less taxes.
Pay less taxes?
Yeah. And then ETFs can also be cheaper. Like they'll have like expense ratio, which is like the money for them to, you know, for the fund every year. Mutual funds, they can be like 1%. Like the Amana mutual fund is like almost 1% or a little bit, maybe less than 1%. But the ETFs can be like 0.35%, some small fee.
Okay.
Someone considers that 1%, it might not seem like a lot, but over time it does eat into your returns as opposed to like the 0.35% with the ETF.
Okay.
and a lot of times they're not outperforming the S&P 500 anyways. Or like maybe after their expenses, they're probably not going to be performing.
Okay.
So it's something to consider.
Bismillah. All right, so we're going to talk a little bit about Islamic finance foundations first. But before I get into this, I do want to share a little bit about what Mahad was talking about with a little bit of examples to really drive it home. So we were talking about different Amana groups, right? So this is their website. So zoom out a little bit. So this is the mutual fund, the Amana Growth Fund, right? This is a mutual fund. Here's a ticker for it. Now, it's not publicly traded as something you can go on Fidelity or other Robinhood, Webull, whatever. You do need to go through their investor login to purchase it. So there's many different mutual funds, like Fidelity has its own Fidelity mutual funds. Vanguard has their own. So you can manage it through there. You can see there's portfolio managers, active portfolio managers, investment approach. They're picking specifically investments that are in accordance with Islamic principle, generally large cap. You can look at different holdings, which companies make up their mutual fund, right? Majority of it is Apple, Nvidia, Broadcom, Alphabet, Google, Taiwan Semiconductor Company, and so on. And different sectors they're divided in. They do have specific pricing, so there's not a fees and minimums. So you can't just purchase it outright. There is a minimum on how much you need to purchase this. Where is it showing? The minimum right here. The minimum investment for a share right now is $100. Institutional shares are available with a minimum of $100,000. So for tax sheltered accounts, no minimum, but $100 is a minimum for this specific mutual fund. There are some mutual funds that have a higher fee, but just wanted to drive that home that this is kind of the difference between here's Amana Mutual Fund, and then here's SPUS, an example of a ETF that you can publicly trade on any platform. You can even do it on Robinhood, for example. Here's SPUS right here. Here's something you can track on SPUS. Here's the price. You can purchase however many shares you want, right? Whatever you want to do right here. Whereas the other ticker for this, right, AMAGX, for example, if I were to search this, it's not going to show up because it's not something you can trade on public stock exchange. Yeah, it doesn't show up. Does that help? Okay. All right, now we're going to jump into the foundations. So right off the bat, we want to start with the couple non-negotiables, right? So we have riba, right? That's something we're taught to avoid. So we're going to avoid few type of stock vehicles you're going to see. You're going to see T-bills, bonds, we talked about. Anything that's related to T-bills, bonds, CD, you may have heard savings account that are CD, certificate deposit accounts, and money market funds. All four are interest-bearing, haram, should be avoided altogether, flat out. Again, can anyone tell me what those are again? We have T-bills, CDs, money market, bonds. There we go. Are they halal?
No.
Okay, good. All right, so things that have excessive uncertainty, so things that have speculative nature, things like options, option trading, which is a bit more advanced, and futures. With stocks, you get a contract, essentially, a percentage fractional ownership of a company. Options is you're getting a contract of potentially 100 stocks. It's a derivative of a derivative, which is you don't physically have anything there. It's a contract, so it's a derivative of stocks. And then we have futures, which is, again, a second layer of derivatives, but on commodities. So because of the excessive uncertainty around it, those are generally regarded as haram. And of course, things related to gambling, speculation are non-negotiables. And want to lay down the foundation for zakat, right? The 2.5% annual is compulsory for your portfolio. Many different ways to do this. Detailed approach, which is you just pay 2.5% annually on your entire portfolio. You can have a detailed, for example, only pay on your zakatable assets. We did a Mohsinin presentation led by Imam Muhammad on zakatul mal. Highly recommend you guys take a look at that. It talks about what is zakatable, what is non-zakatable. This detailed approach tends to be more complex, so do what's better and works for you. And consult a sheikh. Okay, Sharia screening. You may be wondering, hey, what do I invest in? There's so many different companies. What is the right company for me to invest in? There's really two steps. One is qualitative screening. At a core foundation, what does the company do? Do they sell alcohol? Do they sell weapons of mass destruction? Right? Do they sell just plants, nursery? Right? These type of things. These are things that you need to first do a fact check on. And then the second is, how is the company financed and operated? Are they operating like a bank, essentially, where they're taking investments in and they're essentially loaning money out because of the cash reserves they have? Those are kind of the steps you need to do to find out whether or not something's Sharia compliant. I will go into a bit more detail about the ETFs we saw. We saw what companies they have screened and said these are halal. I'll show you guys how you can find out a huge list of companies that are pre-screened that you can look at. So of course we know these are the sectors that are haram, right? Anything that has tobacco, acts as a financial service, pork-related, gambling, and so on. These are considered haram sectors to invest in, or any company that invests in any of these as a core business, immediately rule it out. There is a Sharia standard by AAOIFI, which is American Association. I'm forgetting what the acronym stands for, but this is a large Sharia standard set by out of Bahrain, and it's followed by other organizations. But that's just one of many different standards. They say 5% of permissible income from prohibited sources is allowed. Now, can anyone give me an example of this?
For example, American Airlines, their core business is flying transportation, but they do sell alcohol on board.
That's right.
You have to see how much of their money comes from that alcohol.
That's right. So their core business isn't alcohol serving, right? But they do sell alcohol on planes, and that is below, as long as it's below 5%, it's deemed permissible under the Sharia standard. Okay. Any questions before I move on? Okay. Boring is beautiful. Consistency, consistency, consistency. And starting today is the most important part. Don't delay your financial journey. Every day does count. We've talked about the life-changing journey and all that stuff. I'm going to skip a couple of these. Okay. This is kind of important. So everyone who is employed has employer-provided retirement account. You can either get a opt-in for a 401k, 403b. There's very minimal difference between those two, but ideally, if you want to get a self-directed brokerage account, which I know some folks at Humana have been able to get, and GE, that's the ideal state, is self-directed brokerage account, meaning you have full ownership of what you're investing in. Like Mahad mentioned, these are mutual funds. For example, let's say your company has partnership with Fidelity, right? You have only option to Fidelity mutual funds to invest in for your 401k. Those might not be halal. So if it's self-directed, you have full ownership of what you invest in. You can pick ETFs, stocks, whatever you want. That's the ideal situation. There's traditional IRA, which is individual retirement account. You manage it. it's something you can open up with any company, whether it's Vanguard, Fidelity, whatever. Roth is great. Highly recommend if you can invest in Roth. This is after tax, but the growth is tax-free. You're essentially, and retirement withdrawals are free. Why this is important is it gives you full control to halal investments. You can invest in the SPUS ETF that I shared earlier, or halal ETFs, and you can just watch it grow, and you can withdraw money early. Roth is an amazing option for anyone who has kids. We have a couple different options for kids. There's a 529, which is haram because it is also interest-bearing. But Roth for kids is amazing because it gives your children essentially a early head start, a 20 to 30 year early head start. The reality is every one of us starts to contribute to these retirement accounts when we start working, which is in our 20s or 30s. You're effectively giving your kids a 20 to 30 year head start, and that's going to compound dramatically over that decade, over those 2 decades.
Can I emphasize? So I just made a point between traditional and Roth IRA. For the traditional IRA, imagine you have a seed, right? They're not going to tax you. It's going to be like you can pull your money before it's taxed, right? Not bad. You might think, oh, not bad. I could get a lot of money out and invest it. But look at all the growth that Ahmed was trying to show you over time.
Yeah.
All that growth will be taxed later.
Yeah.
Versus if you go with a Roth IRA, they will tax the seed, which is small, but all the growth, all those years, if you're still alive, you can get them out, not taxed. That's the key benefit between them. I'm running the wire.
What happened?
I don't know if this is with the IRA, but I think one of them, right? Like you can't pull it out before you retire, or else they're gonna.
That's the traditional and 401k. You are penalized for early withdrawal. I mean, you are with this Roth too, but the growth is tax-free. That's the benefit. Health savings account, if your employer offers it, amazing. If you don't end up using it, you can use the remaining money for whatever you want. This is great because it's called a triple tax advantage, meaning it's the money going in is pre-tax, growth is tax-free, withdrawals are tax-free, so it's like triple tax advantage. Here are the contribution limits for 2025 and 2026. Conscious of time, I do want to skip through a couple of these so I can jump into a couple additional things we talked about. So halal ETFs, there are few. SPUS is a major one, which tracks U.S. large market cap organizations. We have HLAL, which tracks large and mid cap. Then we have mutual funds. We talked about the Amana funds. There's also Azad funds that were listed. If you're curious about individual stocks, there are tools and apps like Zoya and Musafa, which help you do real-time tracking of Sharia compliance. Just because a company may be Sharia compliant today doesn't mean it's going to always be Sharia compliant. A great example is, let's say Apple somehow decides to open up they did open up a credit card business a while back, but let's say instead they move away from phones and consumer electronics into that credit card and banking sector. If they position themselves as that, they're no longer halal. So it is worthy to check on a quarterly basis. We talked about the prohibited zones, options, futures, short sellings, haram. Here's some scholarly rationale behind it, but it's pretty much akin to gambling. We'll talk a little bit about this because this is kind of important. How you structure your investment at different ages is also important. You may be wondering, hey, how can I get gold, or REIT is real estate investment. So if you can't get gold, you can purchase gold derivatives in stock. For example, there's, let's see, GLD, which is a SPDR Gold Trust. And if you look at gold price today, it's not too far off, but let's see. Let's see SPDR Gold Trust. Here it is. So this is SPDR Gold Trust, which is it's an ETF. It's an ETF that is pretty much backed by gold itself, 1 ounce of gold. You can look at it in more detail. We don't. But if you don't, you can either buy gold through Costco, physical gold, but then you have to store it and sell it to really get your cash back if you want to, or you can invest in ETFs like SPDR GLD, which is backed by gold. And it's great for if you have retirement accounts where you want to invest in something. You can't really take the money out to buy gold, because if you take money out, you're going to be penalized for tax, early withdrawal penalty, and potentially tax. You'll have to pay for capital gains. Whereas this, you can use it to invest in gold directly. Okay, couple mistakes that are made by young Muslims in finance waiting to start. This is the biggest. There is opportunity cost. You've heard the saying, time is money. There is a reason for that. The longer you wait and delay, you are essentially leaving money on the table. And there's an option taken that everything is haram. We should avoid it altogether. That's not the reality. There are halal options for investments. And there is a concept of purification under one of the Sharia standards. I'm going to skip this one. Employer matches. This is free money. A lot of employers offer dollar for dollar or whatever up to a certain percentage. That's free money you're leaving on the table.
Real quick, I want to add something for number 4, because you mentioned some of the employees at GE, they got them to allow self-directed brokerage accounts. Don't just go to your company alone. Find other Muslims that work with the same company. That way, you're applying pressure to allow you to take that halal route, because that's what they did at GE. It wasn't just one person went. They went as a group, and they got it to where they can do the self-directed brokerage account.
That's a good point.
Information, contact me. It took us 2 years to fight them.
Yeah. But was it worth it though?
That is,
See? Alhamdulillah.
everybody, there are so many Muslims working on the assembly line. They come to me and I say, help them set up self-directed account.
Alhamdulillah.
You should come to Ford, because they've been fighting them for 4 years, no movement. Media. At Ford.
Alhamdulillah. May Allah make it easy. All right. Last few things. Chasing get-rich-quick schemes. Investing in that Bitcoin may not get you the Lambo, but boring investments are the key, and no diversification. When you're only investing in one stock, one sector, you're really putting yourself in danger, because of it's high risk, high reward. If you only invested in NVIDIA, you wouldn't be sitting in this room. But no diversification also has harms. You have a potential of picking bad stocks and a lot of failure there. So emotional investing. You're seeing messages from that uncle or auntie on WhatsApp saying, hey, I'm investing in this, or FOMO because you're getting a lot of people, you're seeing people on TikTok investing in NVIDIA or gold or all these things. Emotional investing is an area where a lot of people lose a lot of money. Neglecting zakat, again, that 2.5% on your total zakatable assets is very important, and doing it alone. Now, if you want to invest and haven't started, there are a lot of different user-friendly options. I personally am a fan of Robinhood, but there's others like Acorn, Webull, Public, SoFi. They offer a weekly, monthly, recurrent option to. I know Acorns has a option where if you're purchasing groceries, it'll take a couple cents and put it towards a savings account or something for you to invest. And Robinhood, Webull have a public option. All three have an option to do weekly contribution, invest, and so on. If you're advanced and expert and want to look at a bit more things, there is Schwab, Fidelity, Vanguard, TD Ameritrade. TD Ameritrade is part of Schwab's now, but these three are pretty much the main ones if you're looking to do a bit more advanced trading. All right. Now, I promised you guys I would show you guys a couple things. So, Yahoo Finance is amazing. Let me first start there. Can you guys see it good here? Do I need to zoom in? Okay, so Yahoo Finance, here's a list of top mutual funds. All right, these are mutual funds. Here's Fidelity ones, here's Consumer Staples, and all these others. Let's just take a look at this Fidelity Advisor one. You can look on each of these, what the top 100 holdings are of these mutual funds, but we don't care about just any, we care about the Islamic ones. So let's take a look at the Amana Growth, Azad Fund. They list their different holdings. If you're completely unexperienced and want to be totally hands-off, there is Wahid Robo-Advisor, which is essentially, let's say you invest money and you select your portfolio, they will automatically do all the tracking of Sharia compliance and investing on your behalf. And here's pretty much a monthly fee you would pay if you put in $1,000. And you can select your portfolio, you want it conservative, aggressive, they'll take all that for you. This is a very nice hands-off approach. If you want to continue to invest, it's pretty much a robo-advisor that'll take care of all of it for you. But if you consider yourself an advanced trader and want to take ownership of it, there's two main ETFs. If anything you walk away with, just remember these two ETFs, SPUS and HLAL. So there's HLAL, that's the Wahid Sharia ETF, and then SPUS. Walk away with these two things. These are the only two ETFs you need to remember. You can go on their website, for example, HLAL ticker. You can look at their, where is its investments? Schedule of investments, no, not that one. Let's look at schedule of investments. I'm looking for, there we go, holdings. So they have a Excel sheet called holdings, which lists pretty much all of their holdings that they hold in HLAL. SPUS, very similar. You can look at holdings. You can download a full list of holdings. Here it is. Let me open this. So we're all looking at the same thing. So here's a SPUS. Here's a ticker, list of tickers that they have, that they've done the due diligence. You don't need to figure out, hey, is this stock halal? Here's a list of 214 stocks. That gives you plenty of stocks to kind of work with and figure out, hey, what should I do here? I'm just going to ask ChatGPT to just create a word cloud. And from HLAL, here are the tickers. Removing duplicates, because there's going to be duplicates. All right, essentially what this is all the stocks and tickers that these companies that both HLAL and SPUS have deemed to be halal. And from here you can use ChatGPT or others to essentially condense this down into something more manageable for you to look at. But while it's ChatGPT is thinking and doing that, let's take a look at this. Zoom in a little bit more. So they list weight, how much of their portfolio is made up of this. For example, Apple makes up 15%. You can look and see Cummins, which makes engines and other things. Cisco, they've deemed as halal based on different criteria. DocuSign, and a couple other companies that you may be familiar with, eBay and all that stuff. They've essentially done the heavy lifting for you. This gives you 219 here. SPUS has 200 something there. Between the two, you're looking at approximately 200 something tickers that you can pretty much invest in at a halal glance. Okay, here we go. Here's a word cloud. All right. So here's a few companies. So we have Tesla, Home Depot, Lilly, Google, AbbVie, Nvidia, Apple, pretty much Microsoft, AVGO, Exxon. These are major companies, right? That you can be rest assured these are halal and you can invest in them for now. Again, it's worth going over and looking at these companies' holdings quarter over quarter. There's a reason why this gets regularly updated. Let me look at what SPUS was updated. This was updated as of 2 days ago. So they change this on a periodic basis. So you need to make sure you reference this list as a standard on what to invest in. Any questions? Okay. What are the two ETFs that I mentioned were halal to invest in?
SPUS and HLAL.
Yep. And here's an example of how you can do it, right? You can simply type in HLAL on, let's say, Robinhood, right? It's listed at $62 per share, and you can buy a share. Right now I'm not signed in, so it's saying sign up to buy, but you would effectively buy it here. For reference, over the last 1 year, HLAL has seen 13% growth. I'm going to do a side-by-side split screen, actually. So we have SPUS here, and okay. So I have on the left S&P 500, and on the right I have SPUS. So you can see over the last 1 year, SPUS has had more growth compared to S&P 500. That has to do primarily with the companies that S&P 500 makes up. There are companies that are losers by our Islamic standard, right? They contain more interest, more debt, and SPUS is actively managed, and they rebalance their portfolio on a quarterly basis. Whereas S&P 500 is pretty much static until end of year. There are companies that go in and out of S&P 500 on an annual basis, but SPUS quarterly basis. So that's one of the main reasons why you're seeing 14.9 and 15% return here versus 12.45. It pays to invest halal. All right, that's all I got.
I just want to say something. So we mentioned a lot. We mentioned a lot of things during this presentation, but I just want to kind of like just dumb it down for you guys. Like, let's say you're not an investor and you don't have an investment account. What should you do? Where should you start, right? I'd say number one, open an IRA account. I would not open it with your bank. I would not open it with an account that you're going to see every day. Like your bank account, you might see it all the time. Go to Schwab, go to Vanguard, open it. You can set up recurring. You can set up recurring deposits from your checking account to your investment IRA account, and then from there you can set up to where you purchase SPUS every month. So I would say start with $500 a month. The IRA limit is about $7,000. If you can do $500 a month, put that into your IRA account, have Roth IRA account. Have it set up to purchase SPUS or HLAL every month and forget about it. And that's basically that chart that we were showing you at the beginning. In 50 years, you should be a millionaire. And, basically, that's just the very basics. Like, if you don't have to do any research, you don't have to, you know what I'm saying? That's all you have to do. And I recommend an account where you're not looking at it, so that way you can kind of forget about it. It takes all of the emotion out of it. You're not going to be like, oh my God, I'm losing money, or like, look how much I made. Look at it like once a year or something. I think you're going to see the progress, and you're going to see why it's important. But yeah, that's the important takeaways from today.
Yeah, that's if you have, say, goals for retirement investment, right?